gold is not going up. The dollar is going down. Now, gold is constant by weight. As I said, it's an element. It just sits there. But in the time I've been an investor, it took $700 to buy an ounce of gold. I have friends who bought it $200. Good for them. I'm very happy for that. But I started buying around $700. It used to take $700 to buy an ounce of gold. Today it takes about $2,900 to buy an ounce of gold. The ounce of gold hasn't changed. What changed is that the dollar has collapsed. Now, people keep saying we have a strong dollar, yes, and I hear that all the time. And I look at them and I say, compared to what? Meaning, yeah, compared to the euro and the yuan and the yen and Swiss francs and sterling, yes. But compared to gold, no. The dollar has collapsed compared to gold. So that to me is a better metric.
Jim Rickards, a New York Times best-selling author, highlights that gold never truly settles. It is continuously rolled over in the markets. He emphasizes that while the dollar is weakening, gold remains constant in weight. Recently, extreme price dislocations in gold have faded as tightness in the physical market eases, suggesting that the rush to ship bullion to the U.S. may be subsiding. This surge was driven by fears that gold could be included in President Donald Trump's broad tariff measures, leading U.S. gold prices to spike above international benchmarks. The resulting price gap between New York's COMEX and the London spot market created an arbitrage opportunity, prompting traders to send gold to the U.S. to capitalize on the premium. Addressing concerns over a potential short squeeze, Rickards pointed out that the COMEX has built-in mechanisms to manage such situations. If many long position holders request physical delivery, the exchange can change the rules, limiting transactions to trading for liquidation only. He also dismissed the idea that gold futures markets could be used to break the financial system, reiterating that futures exchanges are not designed to be a primary source of supply. Trump's tariffs are widely viewed as inflationary, driving more investors toward gold as a safe haven asset. This has contributed to gold's more than 10% gain this year. However, higher inflation could also pressure the Federal Reserve to maintain elevated interest rates for longer, which may weigh on gold's appeal due to its non-yielding nature. While concerns about tariffs impacting gold shipments persist, Rickards noted no clear evidence of bullion being moved to evade them. Although tariffs on UK and Swiss gold have not yet been implemented, he acknowledged that they could become a factor. We're about to explore the video, but first subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
Gold might be affected by the tariffs. It's like Trump put these tariffs on. They applied to everything. Now he's creating carve-outs, as he said. The auto industry, they're getting a 30-day pause, but the tariffs are extremely broad, so they would apply to gold in the first instance, unless he carved it out, which he hasn't. Having said that, it won't have any effect on the global price of gold. The reason is that gold is kind of like oil, gold, a couple other things. These are global prices. They're produced all over the world, not everywhere, but in every part of the world. They're consumed in every part of the world, and they're easily substituted. So if the U.S. doesn't buy oil from Saudi Arabia, we don't buy that much from Saudi Arabia anyway. We can buy from Venezuela. If Canada cuts us off, we can buy more from Mexico or more from Venezuela. But the same is true of gold. The price is set in two places: the London bullion market and the COMEX, the New York commodities market. And physical prices and paper gold prices vary. There's a lot to it. But my point being, if there's a tariff on gold coming from Canada to the U.S., we'll just buy it in Shanghai, buy it from Africa, buy it from Switzerland. The point being, when a commodity is truly generic, a car is not generic. You get a certain brand and a certain set of features, and it's electric or hybrid or whatever. Cars are not generic. Gold is. It's an element, atomic number 79. So the point being, when you have a generic, fungible global commodity, tariffs don't affect the price, because if you're getting hit with a tariff, you just don't buy it from that source, you buy it from somewhere else. Now, getting back to your other point, Danielle, about shipments from gold, yeah, it does appear that there was some kind of short squeeze emerging, and that shorts were having trouble getting physical gold to satisfy deliveries. Now, that can only go so far. If you look at, say, how do you get short gold? You sell gold futures on the COMEX, 1 month, 2 months, 3 months forward, and then you get to the end of the contract, and the buyer says, "I would like physical delivery, please. I don't just want to pair off or roll over my contract." That's a paper transaction. That's the way most futures settle. But if someone long the future says, I'd like to take delivery, please, then yeah, you got to look at the warehouse and see what's there, and if there's not enough, you might have to get it from London or some other source. Now, that appears to account for some of the deliveries and some of the urgency about that. Having said that, there's a limit on that, and you have to read the COMEX rule book. I'm enough of a geek. I actually have read the COMEX rule book, but there are two important rules. Number one, they have a rule that says they can change the rules. So if things get tight or things get disorderly, they can just say sorry. No more physical delivery. We're trading for liquidation only. You can pair off your contract, roll it over, but you can't take physical delivery. They can just say that. And it is what they did to the Hunt brothers in 1980, I believe, 80 or 81, when they tried to corner the silver market. But there's another principle, which is also in the rule book, but it's just more broadly stated. Futures exchanges say, all of them say, we are not a source of supply. Now, it is true that you can provide notice and take physical delivery of the gold in a futures contract. That is true. But they only want a little sliver of that just to kind of keep the paper price and the physical price in line by linking it to the physical price through physical delivery. In some cases, there's a little bit of an arbitrage, but not much. It basically keeps those two prices in line. That's the purpose of it. If all the shorts, all the longs got together and all put in notice of physical delivery, I promise you, by noon that day, the COMEX would say, sorry, trade for liquidation only. You cannot take physical delivery. We are not a source of supply. So this notion, a lot of gold bugs have it, that somehow you could use the futures exchanges to break the market. No, you can't. Only to a point. So, and it may be, I haven't seen any evidence that gold was being shipped to beat the tariffs. And we haven't even put tariffs on the UK or Switzerland. We probably will, or at least the UK, but not yet. And so I think there might have been a mild short squeeze unfolding, and that accounts for the physical deliveries, but that's not going to go too far because the futures exchanges can shut it down.
Global physically backed gold ETFs saw significant inflows of $9.4 billion in February, marking the most substantial monthly increase since March 2022. North American flows turned positive after 2 consecutive outflows, recording one of the strongest months. Asian demand also remained robust, while European inflows moderated. This marks the 3rd straight month of strong global inflows, which combined with an upward trending gold price, have pushed total assets under management to $306 billion, another month-end peak. Meanwhile, total holdings rose to 3,353 tons, the highest since July 2023. According to Jim Rickards, retail investors are beginning to show more interest in the gold market but are not yet the driving force behind its price movements. He emphasizes that aggressive central bank buying is the primary catalyst for gold's rising price. Rickards views this trend as part of a larger geopolitical and monetary shift, with central banks steadily accumulating gold to reduce their reliance on the US dollar. Now let's redirect our attention to a video.
Retail is a little more active, you're right about that, but they're not really driving the market. In a panic, they will, but it'll be too late. I mean, it'll be, I was saying buy gold at 700, 1,300, 1,900, 2,000. It's now close to 3,000. People just don't do it. It's fine. I'm not in charge of their finances, but people just don't do it. The funny thing is, Danielle, this is just human nature. When it spikes to 4,000 or 5,000, then they'll run out and buy it. They could have had it at 1,300, but they'll wait until it spikes. That's just human nature. The big buyers are the central banks. They're the players. Some institutions, some hedge funds, but mainly the central banks, and we know who they are. It's Russia and China, but also Vietnam is a big buyer. I mentioned their trade surplus earlier. Okay, what are they doing with the money? Well, one of the things they're doing is buying gold. Kazakhstan, Turkey, Iran's buying it. They're non-transparent, but they're buying it, and Mexico and many others. So the central banks are driving. The inflection point was 2010. From 1970 to 2010, central banks were net sellers, but since 2010, they've been net buyers, but the amount of buying has been going up. I mean, Russia has increased their gold reserves by 5 times. In 2009, they were 600 tons. Today, they're about 3,000 tons. That's a 5 times increase in, it's 16 years, but That's still 500% more gold. By the way, that gold has saved them in the Ukrainian war because the U.S. put financial sanctions and tried to steal $300 billion of U.S. Treasury securities that Russia paid for with dollars that they made by selling oil. When we froze the U.S. Treasury securities, and now we're in the process of stealing them, they stole $50 billion out of the $300 billion to make a loan to Ukraine that's never going to get repaid. But Russia had put, Elvira Nabiullina, who's the head of the Central Bank of Russia, she had put 25% of their reserves in gold before the war in Ukraine, again, in this period since 2009. Now, here's one of the ironies, and shows how much the U.S. doesn't understand about this. The war and the central bank buying and the kinds of things we've been talking about have driven up the price of gold so much that Russia has made $100 billion of profits on a mark-to-market basis on their gold. So, yeah, we froze $300 billion in Treasury securities, but they've been continuing to sell oil and natural gas, and they've made $100 billion on their gold, which thanks to us because we're the ones causing all the problems. So, so they're the driving force. Now they have to be. Russia has been they've shown a lot of finesse in how they do it. They buy 10 tons a month, 20 tons a month. Some months they skip. Recently they haven't reported anything. I don't think that means that they're not buying gold. I think it probably means they're buying the gold through the sovereign wealth fund instead of the central bank, which is what China does. China's been buying gold all along, but we don't really have hard data because they don't buy it through the central bank. They buy it through their sovereign wealth fund with something called SAFE, State Administration of Foreign Exchange. So they have these pockets where they can buy gold without putting it on the central bank balance sheet. But that's what's really driving the price of gold. And if you thought about it, you say, well, gee, why doesn't China just, announce what they're doing and, bid up the price of gold and make a lot of money? Well, the answer is they're not done buying.
Exactly.
See, if you were buying, you wouldn't want the price to go up until you have all you want. When you have enough, that's different. But if you're still a buyer, you want the price to be moderate. So what's going on is a great game involving the major powers, involving gold. There's more to it, but that's what's driving the price higher.
Gold's rising price reflects a broader shift in the global financial system, driven primarily by central bank accumulation, geopolitical tensions, and a weakening U.S. dollar. While retail investors are becoming more active, institutional players in nations like Russia, China, and other emerging economies are the proper demand drivers, using gold to hedge against financial instability and reduce reliance on the dollar. The easing of price dislocations suggests market stabilization, but ongoing geopolitical and economic uncertainties support strong inflows into gold ETFs and physical holdings. As inflationary pressures, debt concerns, and monetary policy shifts persist, gold remains a crucial safe haven asset in an increasingly uncertain world. What's your take on this? Are you more inclined to hold physical gold or prefer gold ETFs? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.